Have you ever wondered how to become a millionaire by your 30s? It's a dream shared by many, yet realized by few. The path to financial freedom at a young age is like a journey through a maze, filled with challenges and opportunities. It requires more than just ambition or luck. It demands financial knowledge, discipline, and strategic planning. It's about making money work for you instead of the other way around. Remember, becoming a millionaire by your 30s isn't impossible, but it does require some serious planning. The first step towards becoming a millionaire by your 30s is to start early. Now let's unpack why this is so crucial. Starting early gives the most precious asset of all time. Time for your savings to grow, time for your investments to flourish, and time for the magic of compound interest to work its wonders. Let's talk about compound interest for a moment. It's the concept where your interest earns interest, creating a snowball effect that can significantly grow your wealth over time. Think of it as a seed. The earlier you plant it, the longer it has to grow into a sturdy tree. The same principle applies to your finances. By saving and investing from a young age, you're planting your financial seeds. Over time, these seeds grow, and thanks to compound interest, they grow exponentially. Remember, the earlier you start, the bigger your potential returns. Investing wisely is key to growing your wealth. Let's dive into the world of investments. There are different types of investments that you can consider. For instance, stocks, bonds, and real estate. Stocks are shares of a company that you can buy. When you own a stock, you literally have a piece of that company. As the company grows and profits, so too does your investment. Stocks have the potential for high returns, but they also come with a level of risk as the market can fluctuate. Bonds, on the other hand, are a bit safer. When you buy a bond, you're essentially lending money to an entity, like a government or a corporation. In return, they promise to pay you back with interest after a certain period. Bonds are generally considered lower risk than stocks, but the trade-off is that they also usually offer lower returns. Then there's real estate. Investing in properties can be a great way to generate regular income through rentals, and the property itself can appreciate in value over time. However, real estate requires a significant upfront investment and can come with its own set of challenges. Now, the trick to smart investing isn't just about picking the right investment, it's about diversification. That means spreading your investments across different types of assets. Why? Because different investments behave differently at different times. If one investment is doing poorly, another might be doing well. Diversification can help balance out the risk and keep your portfolio healthy. And let's not forget about the long term. Investing isn't a get-rich-quick scheme. It's about consistent growth over time. That means having patience, keeping an eye on your investments, and not panicking when the market dips. Remember, it's not about timing the market, it's about time in the market. Investing might seem daunting at first, but with a bit of knowledge and a solid strategy, it can be a powerful tool to grow your wealth. Just remember to do your research, diversify your portfolio, and think long-term. Smart investing isn't about making a quick buck, it's about consistent growth over time. Another path to millionaire status is through entrepreneurship. Now, this route isn't for the faint of heart. Building a successful business from the ground up requires a unique blend of passion, tenacity, and a dash of calculated risk-taking. It's like navigating your way through a maze in the dark, but the potential rewards are immense. Imagine creating a product or service that fills a gap in the market, or better yet, creates a new market entirely. The financial gains can be significant, but remember, with great potential comes great risk. Many businesses fail within their first few years, and it's crucial to be resilient in the face of these setbacks. Entrepreneurship is not just about making money, it's about creating value. It's about transforming an idea into a reality, and this could be your ticket to not just financial success but also personal fulfillment. Entrepreneurship is a high-risk, high-reward path, but it could be your ticket to becoming a millionaire by your 30s. Living below your means is another crucial element on your path to becoming a millionaire. Imagine your income as a river flowing into a reservoir, your savings. The goal is to keep this reservoir full and growing. To do this, you need to control the outflow, your expenditure. This is where frugality steps into the picture, acting as the dam, controlling the outflow and ensuring that your reservoir, your savings, keeps growing. Spending less than you earn may sound like common sense, but it's surprising how many people struggle to stick to this principle. This habit is the cornerstone of financial discipline, and it's where frugality begins. It's about making conscious decisions about your spending, ensuring every dollar is put to good use and not wasted. Avoiding debt is another critical aspect. Debt is like a hole in your reservoir, draining your savings and slowing your progress towards your millionaire goal. If you must borrow, let it be to invest or create additional income streams, not for consumption. And of course, saving as much as possible. The more you save, the faster your reservoir fills up. It's not just about stashing cash away, it's about making your money work for you. This is where budgeting comes in. It's your financial blueprint, guiding you in allocating your resources wisely and keeping you on track. Remember, a millionaire isn't someone who spends $1 million, but someone who saves and invests $1 million. Becoming a millionaire by your 30s may seem like a tall order, but with the right steps, it's within your grasp. So let's revisit the key strategies we've discussed. First, the importance of starting early cannot be overstated. Time is a valuable asset, and the sooner you start saving and investing, the more your wealth will grow. Next, we talked about smart investments. Diversifying your portfolio, understanding the market, and making calculated risks are all part of this process. Then, we touched on entrepreneurship. Owning your own business can be a game changer, offering you control over your income and the potential for significant financial growth. Lastly, we emphasized frugality and financial discipline. Remember, it's not just about how much you make, but also how much you save and how wisely you spend. Remember, becoming a millionaire isn't about luck. It's about making smart financial decisions and sticking to your plan.